I'm Nancy Kachingira. Welcome to this special edition of Your Questions Answered. We're going to be looking at what the rise in interest rates means. Now, just to recap for you, the Bank of England has raised rates from 5% to 5.25%. That's 5.25%. Now, the last time rates were at 5.25% was April 2008. Well, to help us talk through some of what's going on, I've got a panel with me to answer some of your questions. I've got Susie Laws with me. Susie is a chartered financial planner. Also got Tayo Oguntonade, who is a property expert and co-founder of the digital platform Bricks with Tips. Great to have you both. And we'll also be joined by our correspondent David Waddell, who will be talking through some of the extra tips that you can use to save money in this time. Right, so why don't we get started? We've got lots of questions from our viewers, and we'll begin with Paul Robinson's question. He says, can you explain how food prices will fall? Because my mortgage payments go up, so he's not quite seeing it all add up. I don't know if you'd like to start with that one, Tayo. How are food prices falling when mortgage payments are going up?
Yeah, it's a valid question for the everyday person to understand, because you think about interest rates, mortgage payments going up. How does that relate to food, right? There isn't actually a direct relationship, but interest rates are being increased to curb the rate of inflation. And at the moment, the rate of inflation is really, really high, which means that the prices of goods and services are just increasing really, really quickly. Now, what happens when interest rates go up is that the costs of mortgages, car finance, business loans all go up. And what tends to happen is that people are a bit more prudent when it comes to decisions like buying a new car, moving a home, or businesses are a bit more prudent. They may think twice about taking out a business loan for expansion. So what that does is it takes a lot of money out of the community, out of the economy, and reduces consumer spending. And that does actually bring down the rate at which goods and services, the prices of goods and services are increasing, and food obviously does fall within that.
All right, Tayo, thank you. That's a great way to sort of explain why the bank is hoping that what they're doing will actually see prices fall during this period of inflation. This next one is for you, Susie. This question came in from Michael Webb. Can you advise when will the banks pass on the interest rate to customers who have mortgages and also customers who have savings accounts, please? Because this is an interesting question, because those two groups are affected quite differently, aren't they, Susie?
They are indeed, and it's obviously a hot topic at the moment. We tend to see that the banks are very, very quick to pass on the increases for mortgage rates to people who are on tracker deals or standard variable deals. What we tend to see is that there's a little bit more reluctance around passing on increases to savings rates. And obviously this is currently a focus of the government. They did call in heads of the banks to try and explain to them exactly why they are not doing more for savers at the current time. And there will continue to be a lot of political pressure for the banks to be seen to being fair to both parties as best they can.
I mean, what sort of reasons have banks been giving, though, for not passing on these rates to customers who are saving?
Well, there's a number of factors, obviously. One of those things is apathy, that they very much rely on savers not checking the rates that their accounts are on. And the bank's defence will always be, we do offer rates or accounts with better savings rates, but it's up to the individuals to look at what rates are available to them. So they do very much rely on apathy, and that people don't check, and that they assume that they're benefiting from the best rates, and often actually they're not. So that's the real point for people to make sure they do check.
Okay, good advice there. Now, question here from Brian Pitwood, who says, when are the banks going to raise interest rates for savers in line with the numerous increases announced for borrowers? So it's a question along similar lines. I think there was some discussion about whether the rise could be good news, for instance, for those who are on the cusp of retirement who might get a better annuity rate. Tayo, I'm going to leave it to you to explain some of that.
Yeah, so the person asked a similar question where it comes to the savings rates in particular. And like we've just discussed, the banks are kind of relying on people not checking out. I think what people are experiencing is that because the base rate has been so low for such a long period of time, there's been a lack of competition. So people haven't shopped around for interest rates in so many years. And that lack of competition doesn't really encourage the banks to increase their rates because people aren't leaving banks. They're not shopping around for better deals. Regarding the annuity rates, it could put some light at the end of the tunnel, especially for people that are closer to retirement. So that could be good for them, hopefully, if they do increase.
Okay, and I'll come to David in a moment, but Susie, if I could just get you to weigh in on this, because this interest rate doesn't just affect people, it affects the government too, and how the government borrows.
It does. So about a quarter, I think, at the moment of government debt is on index-linked basis. So it effectively means that the cost that they have to pay on that goes up in line with what's happening. And that's quite high. I believe it's one of the highest, if not the highest, in the Western economies. So it will impact them going forward as well. It's not just people on the street. However, I don't think too many people are going to have as much sympathy in the government's direction as they're going to have in a lot of people who are struggling day to day in families.
Well, you're quite right. I think focus is deservedly on people who are struggling day to day. Well, David Waddell, maybe you can help us with that, our correspondent in the newsroom. I understand you've got some tips on how to save money, especially now as the cost of living is going up, prices are going up.
Yeah, well, these are some tips that a lot of us are going to have to think through. My own personal mortgage went up by £300 a few months ago, and we managed to secure a 5-year fix, having come off a previous 5-year fix. So a lot of us understand the challenges of having to pay a lot more on our mortgage than we have in the past. Let's just have a look at this this graph, because this shows what, for example, depending on how much money you have on your mortgage, you can see on the left a figure of £100,000. The second figure down, let's focus on that. This would be a typical mortgage for many people across the country. They might have a house that's valued more than that, but their actual debt might be somewhere in the region of £200,000. Now, until recently, they may have been paying somewhere in the region of 2% on that loan. And if they were taking out a new mortgage now, or in recent times, they might now be paying 6%. So the difference we've calculated between paying 2% and paying 6% on a 35-year mortgage. Now, that's a very long mortgage term. But the difference between paying 2% or 6% on the right-hand side, second line down, £477 more every month. So that's towards £6,000 a year. That's the kind of money that people on a £200,000 loan for 35 years would expect to pay every month. And for a lot of people, they're obviously going to find that very hard indeed. Let's have a look at some ways now that people might be able to manage that extra payment. So here's the first tip. Overpay now if possible. Until recently, it may have not made much economic sense to overpay, because in some cases people's savings rates or their investment rates may have been more than what they would have paid in their mortgage costs. But that calculus has now changed. People would now expect to pay, in some cases, a lot more on their mortgage than they would have done by keeping savings. So for those people who have savings, the advice broadly is, unless you need that savings sometime soon, overpay your mortgage. The second tip here is switch, perhaps, if times are tough, switch to an interest-only mortgage, because then you're not making those capital payments. The risk of that, of course, is that if you are not paying back, then you still have to pay back at some point. I've been asked to leave it there.
Okay, well, David, thank you very much. That's some really good tips there, and some good advice. And just shocking how much mortgage payments can actually rise by based on these interest rates. Well, let's go back to our questions. And there's one here from Mick Phillips. Mick is asking, when interest rates are increased to curb spending and subsequent inflation, only the world of finance prospers. Why don't we raise tax rates instead, and then everyone could benefit later? Susie, I'll come to you for this. I suppose really at the heart of this, he's asking, why is this the only tool that the bank seems to have? It seems to be, to him, a rather blunt tool.
It is, and obviously don't forget, so the Bank of England is in charge of monetary policy, so interest rates. Fiscal policy, which is around taxation, falls in the hands of the government. So that in theory, they're two separate entities who are trying to manage this. The problem with increasing taxation is that is what then happens to that tax revenue, that money. If the government then puts that back into the economy via spending, infrastructure projects, benefits, all the types of things, obviously the NHS that we would expect them to be doing with that money, and people on the street would expect them to be doing with that money, that can have further inflationary impacts and obviously cause inflation to actually worsen. So it's the goal around increasing interest rates is obviously looking to tighten individual spending as opposed to the government spending. But the idea then, obviously, as we've already alluded to, is that it hopefully slows down the rate of increases around what we're seeing with goods and services.
Okay, and a question from Deb in North London. This one for you, Tayo. High interests, no spare income, and yet apparently we're told there is too much money in the economy. I love the way they phrase this question. Who has the money? Who are these people who've got too much money? Tayo.
I guess it's just a testament to how slow things can move in the economy. What we're seeing at the moment is that the rates of inflation are kind of due to pent-up demand that we saw during the pandemic. So if I give an example, during the pandemic, we saw house prices shoot up in 2020, 2021, and we saw some really, really crazy numbers, especially around house prices. But that goes for all goods and services. What we're experiencing right now is the government trying to steer that and get that back into control. It's not something that's going to happen overnight. And as we saw, this is the 14th increase of the base rate. And even while we were increasing it, inflation was still increasing effectively. We've only started to see inflation cool down recently, which is why it seems that we got a 25 base point increase rather than a 50 base point increase. So to answer that question, it is something that is going to take some time until we see the results, but it does look like we're heading in the right direction.
That's a really good one to answer, Tayo, because I think when we say the Bank of England is raising interest rates because they want people to stop spending money, and we're also talking about a cost of living crisis, that can be rather confusing. But the other question people have is how high will interest rates go? Susie, are we at the end of these rises, at the beginning of these rises? What are we looking at?
Well, hopefully we're not at the beginning, but we're definitely not at the end either, I don't think. Realistically, I think we're expecting interest rates to continue rising towards the end of this year. Slowing, obviously, we don't expect, hopefully, assuming inflation continues to come down any further, 0.5% rises like we saw earlier in the year. But it's likely that they are going to continue going up. And then they may look to come down next year, but I don't see them ever going back to the levels we've had historically over the last 15 years. We've been in had 15 years of 1% or lower interest rates, and that is not a world we're going to go back to anytime soon.
All right. Thank you very much to both of you. Susie Lords is a chartered financial planner, Tayo Oguntonade, who is a property expert and the co-founder of the digital platform Bricks with Tips. And thank you also to David Waddell, our correspondent, for his very helpful tips.